Good morning, dear students. In the last class, we have discussed about fundamental principles of accounting, right? So today, in this class, we are going to study about the conceptual framework of accounting. So the conceptual framework serves as a tool for IASB to develop standards. So this conceptual framework, which helps to the IASB to develop the accounting standard, or we can say that to develop the international financial reporting standard. It does not override the requirements of individual IFRS. So some companies may use the framework as a reference for selecting their accounting policies in the absence of specific IFRS requirements. So here some companies, they follow the accounting framework while preparing the financial statements, understood, in the absence of IFRS requirements. So here the framework for the presentation and preparation of financial statements sets out the concepts that underlie the preparation and presentation of financial statements, that is the objectives, assumptions, characteristics, definitions and the criteria that govern financial reporting. What is the objective of financial statement? The conceptual framework states that the primary purpose of financial information is to be useful to existing and potential investors or lenders and other creditors when making decisions about the financing of the entity and exercising rights to vote on or otherwise influence management's action that affect the use of the entity's economic resources. So this conceptual framework, which is useful to the company, which is useful to the investors or lenders, or we can say that which is useful to the stakeholders of the company to make, or while making the decision about the financing of the entity, or while making the decision about the exercising right to vote on otherwise influence the management action. Understood? So this will affect the use of the entity's economic resources. So this the conceptual framework which use the entity, or which use the enterprise to use the economic resources effectively or efficiently. The framework for the preparation and presentation of financial statements sets out the concept that underlie the preparation and presentation of financial statements, that is the object, assumptions, characteristics, definitions and criteria that govern financial reporting. Therefore, the framework is often referred to as a conceptual framework. So this conceptual framework, it contains the object or the assumptions and characteristics, definitions and certain criteria with regard to the accounting or financial reporting. So this framework deals with some of the points of some of the things here. The object, first one, the objective of general purpose financial reporting. The main objective of general purpose of financial reports is to provide the financial information about the reporting entity that is useful to the existing and potential investors or lenders and other creditors, to help them to make various decisions with regard to the financing. Understood? So here the main objective of financial report is to provide the financial information about the company or about the reporting entity. So that will be useful to the investors, or that will be useful to the other creditors or lenders. So that help them to make to take various decisions. Take for example about trading with debt or equity instrument or of a company or reporting entity. Understood? So the objective of general purpose of financial reporting is to take the decision with regard to the financing. Understood? Second one, general purpose reports that should contain the information about the reporting entity. So here the general purpose or economic resources and claims. So this is called the changes in economic resources and claims resulting from entities' financial performance and from other events. Understood? So here it means that the events should be reflected in the reports in the periods when the effects of transaction occur, or regardless the related cash flows. However, the information about past cash flows is very important to access management's ability to generate future cash flows. Understood? So this is about general purpose reports. So that should contain the following information. Understood? So that is economic resources and claims. Next one, underlying assumptions. So normally two assumptions underlying the preparation and presentation of financial statements are the accrual basis and going concern basis. What is accrual basis? When financial statements are prepared on the accrual basis of accounting, the effects of transactions and other events are recognized when they occur, understood, and they are recorded in the accounting records and reported in the financial statements of the periods to which they relate. So the accrual basis assumption is also addressed in Indian or in International Accounting Standard 1, that is IAS 1, that is presentation of financial statements. So which clarifies that when the accrual basis of accounting is used, items are recognized as assets, liabilities, equity, income and expenses. So these elements of financial statements, and when they satisfy the definitions and the recognition criteria for those elements in the framework. Understood? So this is about the accrual basis. So here in accrual basis, the effects of transactions and other events are recognized under when they occur, or not as cash or its equivalent is received or paid. So this is about the accrual basis. And next one, going concern. What is this? When financial statements are prepared in a going concern basis, I hope these two things, accrual basis and going concern basis, you know already studied, right? Accrual basis and going concern. So in when financial statements are prepared on a going concern basis, it is assumed that the entity has neither the intention nor the need to liquidate or curtail materially the scale of its operations, but will continue in operation for the foreseeable future. So if this assumption is not valid, the financial statements may need to be prepared on a different basis, and if so, the basis used disclosed. So the going concern assumption is also addressed in IAS 1, which requires management to make an assessment of entity's ability to continue as a going concern when preparing financial statements. So this going concern which helps the entity, or which helps the enterprise to make an assessment of entity, or to make an assessment of entity's ability to continue as a going concern. So when it will get when they are preparing the financial statements. And next one, qualitative characteristics of useful financial information. So in this framework, it just describes two types of characteristics of financial information, that is fundamental and enhancing, and fundamental and enhancing, and fundamental qualitative characteristics. Here these qualitative characteristics is again classified into two, fundamental and enhancing. Okay, what is this fundamental qualitative characteristics? So this fundamental qualitative characteristics, it consists of relevance. What is relevance? Relevance means capable of making a difference in users' decisions. Capable of making difference in users' decisions. The financial information is relevant when it has a predictive value or confirmative value, or both. Understood? Or materially is closely related to relevance. And second one, faithful representation. The information is faithfully represented when it is complete or neutral or free from error. So this is about the fundamental qualitative characteristics of the financial information. And enhancing qualitative characteristics of the information, or financial information, are first one, comparability. So information should be comparable between different entities or different time periods. Understood? And second one, verifiability. So independent and knowledgeable observers are able to verify the information. So understood? So they are able to verify the information of the company or books of the account. And the next one, timeliness. So information is available in time to influence the decisions of users. So here this information or accounting information is available in time to take the decisions of users. And understandability. So information shall be classified, presented clearly and consciously. Understood? So information shall be presented clearly, or which should be classified clearly. So this is about the qualitative characteristics of useful information. So this classified into fundamental qualitative characteristics and enhancing qualitative characteristics. Understood? And next one, financial statements and the reporting entity. So the financial statement and reporting entity that classified into two, financial statement and reporting entity. What is financial statement? Financial statement should be provide the useful information about the reporting entity or a reporting company. So in this statement of financial position, it recognize about the asset, or it recognize about the liabilities or equity. Understood, right? So in the financial statement we can see the information about assets, liabilities and equity. Or in the statement of financial performance, so it it recognize about the income and expenses, right? Or else in other statement by presenting the disclosing information about the assets, liabilities or equity, income and expenses, their nature and associated risk and cash flows. So which contributions from the distributions to equity shareholders and methods, assumptions, judgment used and their changes. The financial statements are always prepared for a specific period of time, right? So the reporting period, normally the financial statements are prepared on the going concern assumption. It means that an entity will continue to operate for the foreseeable future, that is usually 12 months after the reporting date. And what is reporting entity? So this is a new concept introduced in 2018. The term reporting entity has been used throughout the IFRS for some time. The framework introduced it and made it official only in 2018. A reporting entity is an entity who must or chooses to prepare the financial statements. It can be a single entity. Single entity means one company. Understood? Or else it may be a portion of an entity. For example, a division of one company. Take for example, if you consider one company, it contains so many divisions, right? Manufacturing department, sales department, accounts department, right? So a portion of an entity, or it may be more than one entity. For example, a parent and its subsidiaries. So reporting as a group. As a result, we have few types of financial statements, that is consolidated financial statement and unconsolidated financial statement. What is unconsolidated financial statement? Consolidated financial statements means a parent and subsidiaries report as a single reporting entity. That is called consolidated financial statements. Unconsolidated financial statements means parent alone provides reports or combined. Example, reporting entity comprises two or more entities not linked by parent subsidiary relationship. So this is about the financial statement and reporting entity. Understood? So reporting entity again classified into single entity, portion of an entity and more than one entity. So here the financial statement classified or into two types, that is consolidated financial statement and unconsolidated financial statement. Next to 6th point, that is elements of the financial statement. The conceptual framework defines the elements of financial statements to be, that is assets, liabilities, equity, income, expenses. What is asset? Already you know that a present economic resource controlled by the entity as a result of past events, right? So this is called, so which are expected to generate future economic benefits, that is called assets. What about liability? A present obligation of the entity to transfer an economic resource as a result of past events, that is called liability. Equity. Equity means the residual interest in the assets of the entity after deducting all its liabilities. This is called equity. And income means increases in assets or increases in economic benefit during an accounting period in the form of inflows or enhancement of assets or decrease of liabilities that result in increases in equity. However, it does not include the contributions made by the equity participants, for example owners or else partners or shareholders. What is expenses? Expenses, that is decreases in assets or increases in liability that result in decreases in equity, right? However, these do not include the distributions made to the equity participants and other changes in economic resources and claims, that is contributions from holders of equity and distributions to them. So this is about the elements of financial statements. So here the financial statements divided into assets, liability, equity, expenses and all, right? And next one, recognition and derecognition. What is this recognition? Recognition means, simply speaking, recognition is what? Including an element of financial statements in the financial statement. So in other words, if you decide on recognition, you decide on whether to show this item in the financial statement. Or recognition process links the elements in the financial statements according to the following formula. What is the formula? Formula here, the framework requires recognizing the elements only when the recognition provides the useful information. Understood? So then the framework discusses about the relevance, faithful representation, cost constraints and other aspects in a detail. And what about derecognition? Derecognition means removal of an asset or liability from the statement. That is called derecognition. So derecognition means removal of an asset or liability from the statement of financial position. And normally it happens when the time or when the item no longer meets the definition of an asset or liability. Again, the framework discusses about the derecognition in a greater detail. So derecognition means removal of an asset or liability, and recognition means including of an asset or liability. And next one, measurement. Here the measurement means in what amount to recognize asset, liability, piece of equity, income or expenses in your financial statement. That is called measurement. Thus you need to select the measurement basis or the method of quantifying monetary amount for elements in the financial statement. So the framework discusses about two basic measurement basis, that is historical value and current value. What do you mean by historical? Historical cost means here is based on, this is based on the transaction price at the time of recognition of the element. Understood? So this is, or the historical cost is based on the transaction price. So at the time of recognition of element, they fix the cost, or they fix the cost for the particular element, a particular asset or particular liability. Understood? So that's why this is based on the transaction price. Current value means, or current cost means, it measures the element updated to reflect the conditions as at the measurement date. So here several methods are included: fair value or value in use or current cost. So each of these measurement bases are discussed. Understood? So the framework then gives guidance on how to select the appropriate measurement basis and what factors to consider, especially relevance and faithful representation. So the issue is here that the equity is defined as residual after deducting liabilities from assets. Understood? So and therefore total carrying amount of equity is not measured directly. So instead it is measured exactly by the some formula is there. So total carrying cost, that is formula. Here is one formula: total carrying amount of all assets less total carrying amount of all liabilities. So that we will get the value of current value. Understood? The framework points out that it can be appropriate to measure some components of equity directly. That is, equity means share capital, but it is not possible to measure total equity directly. Understood? So that is about the measurement. And next one, presentation and disclosure. So the main aim of presentation and disclosure is to provide an effective communication tool in the financial statement. So effective communication of information in the financial statement requires focus on objective and principles of presentation and disclosure. So these are the not on rules. So group similar items and separate dissimilar items. Understood? So first you group the similar item and dissimilar item. So aggregate information but do not provide unnecessary detail or the opposite excessive aggregation to the information. Understood? That's why the framework discusses classification of assets, liabilities, equity, income and expenses in a greater detail, with describing offsetting, aggregation or distinguishing between profit or loss and other comprehensive income and other related areas. So this is about the presentation and disclosure. Next one, concepts of capital and capital maintenance. The framework explains two concepts of capital, that is financial capital and physical capital. Financial capital means this is synonymous with the net assets or equity of the entity. Understood? Financial capital means net assets or equity of the entity. And under the financial maintenance of concept, the profit is earned only when the amount of net assets at the end of the period is greater than the amount of net assets at the beginning. Understood? So after excluding contributions from and distributions to equity holders. And what about physical capital? So this is the productive capacity of the entity based on, for example, units of output per day. That is what physical capital. Here the profit is earned if physical productive capacity increases during the period. So after excluding the movements with equity holders. The main difference between these concepts is how the entity treats the effects of changes in prices in assets and liabilities. That is what the difference between physical capital and financial capital. Understood? So this is about the framework or conceptual framework of accounting. Here if you have any doubts, you can clarify it. In the next class we will study about IFRS reforms. Thank you.